Hi, I'm Josh Freeman. I am an attorney at the law firm Freeman Level, one of the founding partners, and we are a law firm that represent business entrepreneurs and real estate entrepreneurs in helping them structure, scale, and sell their businesses. We created this program and presentation from idea to exit to help teach the legal principles that business owners, managers, entrepreneurs need to know to understand this process, the process of properly structuring their businesses, the process of scaling their businesses and the legal pitfalls in there, and then what it looks like to be able to sell their business and how that works and how that process works. Today we're going to be talking about how to scale your business through selling equity in your business and raising money and bringing on investors. And so there's a number of typical and common ways to do that. The first way we're going to talk about is through a convertible note. What a convertible note is it's essentially a hybrid between a loan and an equity investment. And so what happens is especially for early stage businesses where it's hard to understand what the value of the business is and how much equity should be sold for how much dollars of investment, these can come in really handy. And so how it works is essentially an investor says, hey, I want to invest $50,000 in your business, or $100,000 or whatever number it is. And then they say, I want the option to be able to convert this loan into equity in the future when you take on a new investor or if you sell your business. At that point, I want to be able to convert this loan into actual stock or membership interests in your business and then sell, and then be able to participate either as an owner, an investor, or sell out and get the same profits that you're getting. And how this works, I also want to be able to get a discount against what that future valuation is for being early money invested in your business. So this comes into play when they convert, when there's another round of investing. So say it's $50,000, the investor, a year passes, the company goes out and they raise an equity offering at a valuation of $10 million. So at that point, this investor can take that $50 million, convert it into the amount of equity that would be worth at the $10 million valuation, and then with the discount that he's given, that means you reduce that valuation by what the discount is and increase the number of shares of stock or membership units that convertible note owner gets on the conversion. So they get a little bit more than the people who are investing at that price. And so that's kind of how the convertible note sort of works. And like I was saying, these work really well in pre-valuation companies where it's hard to say, it's more of an idea value that way. Typically, you're going to see these, the people investing in these as family and friends or angel investors, individuals or small entity investors. Typically, your larger institutional investors don't invest at this stage in businesses in general. But as you see, the nice thing about them is they're very quick and easy to do because you're not valuing a business and you're not doing a lot of the heavy lifting legwork. It's just a couple of smaller contracts, and so can take as short as just days to have those prepared, reviewed, and signed and get the money in. To weeks if there's negotiations and things like that. The legal costs are low, and it works really well both with LLCs and corporations. And so that's kind of the convertible note. Shortly after the convertible note, a startup incubator called Y Combinator created agreement called a SAFE, which is similar to a convertible note, but it's not technically a loan. But it functions somewhat similarly to that, and they kind of created this document, and it's become more or less a standard way for pre-round startup and early stage startup investing. Again, it kind of works the same way across the board. The value, it's something that comes in early stage businesses, pre-valuation type businesses, oftentimes done by family and friends, angel investor level. They're quick and easy like convertible notes. They're really affordable and easy on the legal cost side. They're slightly easier to do with a corporation. The standard form is set up for a corporation since it was designed for high growth technology startups, which are the typical portfolio companies of Y Combinator. But you can also do them with LLCs. So there's a lot of great things there. But yeah, the convertible note and saves are typically the types of documents you'll see the most in early stage companies. As your company starts to mature and grow, and it becomes easier to create valuations because you have revenue figures, or you have user counts, or you have assets or intellectual property, or things you can put an actual dollar amount to. When you have that, you're going to see the common equity and preferred equity investments coming into play more. So common equity investment, what that means is that when they invest their money, they will not get paid their money back first, but they will participate in the business alongside of the founders. A lot of people refer to these as like investing in founder shares or other things like that. So you may have heard that terminology, and that's what this is. And so it's people investing, and you participate, get distributions at the same time, pro rata with the founder team and all of those people, and you're not necessarily, the investor's not necessarily protected by having preferred status of repayment. Again, with these types of things, you'll see these investments usually with family and friends, people are comfortable with, angel investors, that sort of a thing. And and since these have valuations involved and there's actual equity changing hands at the time of the sale, the legal cost and the preparation is a little bit higher. There's more documents to prepare. There's more approvals and hoops that tend to need to be jumped through, and that sort of a thing. So it's a little bit higher. It's less than preferred equity because, or at least your first round of preferred equity, because your documents are going to allow for very cleanly and easily common equity investments, whereas with preferred equity, depending on how you structured your business to start, you may need to make some revisions and make some changes. These work really well with LLCs and corporations. And this is a really favorable option to the founders because you're not providing the downside protection. So if something goes bad in the company, you're not able to sell it for what you wanted to sell it for, and you end up selling for less than what your investors have invested. You as a founder, you're still going to make some of that money, whereas with a preferred investment, you're really not. You're not entitled to anything because you have to pay back your investors first. So now moving to the preferred equity, this investment is that type of investment that has that downside protection. So your investors are going to, if you have to sell for less than people have invested, they're going to get their money back first before you get money. And if things go well, they'll be able to participate with you in the upside as well. The preferred equity, the National Venture Capital Association have created some standardized forms that are used very regularly in these types of preferred equity investments, and especially if it's a venture capital firm that's investing in your company. And so that's a great resource for documents, information, other things that way, and many lawyers use their standard documents so that the negotiation is more streamlined and easy because you're working off of industry standards. But these are more complicated transactions, ones with more negotiations. Typically starts with a pretty robust term sheet that gets exchanged and signed that goes over a lot of different provisions and clauses about the different types of protections that the investors are going to get, and and those kinds of things, and then once that term sheet's signed, it typically then goes to the attorneys to draw up all of the documents and get that done. Most of these documents are set up to work with corporations, kind of like with Y Combinator, and so it's a little easier to do with a corporation. It's a little more streamlined, but also still very doable with the limited liability company. But yeah, so that's kind of the preferred equity investments. So this has kind of been a quick overview of equity investment options. And typically you kind of see these things work down in this order. So at the early stages, you look at convertible notes and safes. As you start, moving out of that, you'll a lot of times see some common equity investments. And then as you start getting more and more aggressive with your raising funds, you start seeing the preferred equity investments with more institutional type investors. So thank you for taking your time and listening to this. If you have any questions, you can reach out to myself at this email address, josh@freemanlevel.com, or you can reach out to our law firm on our website at freemanlevel.com. And good luck, and thank you.